When the BOM did that prediction of El Nino around October last year and we had that collapse in sheep and cattle prices, that put a real dent in confidence as it relates to real estate transactions. And so from Q4 2023 into what I would say is probably the first half of 2024, things have been quite difficult. So deals are taking longer, there's been less buyers in the market. Overlaying that was the 13 increases in interest rates. Those interest rates themselves aren't necessarily a reason that people can't make the numbers work. I think income's been more important than the cost of land and some confidence around income, if you like. But all of those things together, I think, had a very significant effect on confidence, and we came off extraordinary highs into what has been probably extraordinary lows in terms of buy demand. And so there's been, certainly at the bottom end of the market, sub $50 million, I think there's been a stalemate between vendors and purchasers up until probably the middle of this year. What we are starting to see now is people certainly have got their heads around cost of money. Banks are open for business. Everybody, as we're running into Christmas, looking to get deals done, even below $50 million. And I think there's some confidence coming back, particularly in that red meat sector, sheep and cattle. Grain, less influenced by all of that. Cotton has been marching on, going very well. There's been some of those land use change markets, where you see people going into Northern Australia wanting to do cotton, for example. That's been quite robust. Western Australia probably dented by a lack of rainfall at the start of their cropping season. I think that's all turned around now, particularly in the Northern Wheat Belt. The Northern Wheat Belt's having an extraordinary time. And there's probably, three geographies that still continue to suffer from, poorer climate and as a result of that, a lower ebb in confidence. Western Victoria, Southeast South Australia and Tasmania, all still difficult places to get a deal done at the present time. We're really seeing a widening of that strata between institutional investment and mum and dad investment as we go into the end of 2024. There's an extraordinary amount of money around, mostly North American, some European, a little bit from other places, in terms of international investment looking for a home in Australia. Equally, there's a number of those groups who were in 10-year funds that came out of the back of the GFC and invested in agriculture in Australia that are now looking to sell. And so that's quite interesting. There's quite a bit of churn that's going on between the institutions at the present time. Queensland land tax, the surcharge, is influencing some of that and bringing some of that forward as well. But interestingly, there's some money to meet that at the other end. Above $50 million, the market's been good basically all year. And what you tend to find is most of that money runs on a calendar year. And so that accelerates into the second half of the year as people really want to get some deals done before they miss their deployment window for 2024. But above $50 million, the market remains very, very strong. Natural resources as an ability to either hedge against climate or potentially provide nature-based climate solutions, I think, is something that's driving a whole lot of new money into that sector. There's a lot of that. There's still this traditional money that wants to be invested in ag. They would say it's not, but I would say it is. The exchange rate, I think, is an influencing factor. So we've been rolling along up until just recently at sort of sub 65 cents. But I still think that represents good value. So if you accept that, in US dollar terms, the Australian currency is regularly, 70, 75 or 80, then there's a bit of insulation that's built into any transaction, if you like, if they're bringing the money in at 65 cents. So, and like I said, the money would say that that's not the case, but I'm relatively confident that it helps. In terms of all of the places in the world where people can invest in agriculture, if they've made an allocation to natural resources, it is easier, typically speaking, to do a deal here than it is in other parts of the world. And from a sovereign risk point of view, rule of law, all of those things, we still remain attractive. I think the thing where we're prospectively A danger of kicking an own goal, though, are these continuing layers of taxation. So you talk to any politician and they say, well, I'm never going to lose any votes if I continue to tax a foreign investor. That's fine, but we shouldn't be so short-term in our thinking that we don't think about what the multiplier effects are of that money coming in, what the benefit through our economy are of increased investment in utilising those natural resources, particularly in a state like Queensland, and what the impacts of continuing to layer those taxes on mean. If you keep putting a weight on a horse, if you keep handicapping the horse, eventually it won't win the race. There are probably two distinct classes of sellers. There are those that are interested in today's price, or should I say yesterday's price, if you like, what the peak of the market was and what the newly accepted district values for land are. And there's a group of them. We've got a demographic issue in farming generally in terms of the age of farmers. So if a farmer's selling, he or she may not have a physical succession plan in terms of kids or family members to take over, and so the succession will be by cash by realisation. In that circumstance, some of those farmers that held on through 2000, 2021, 22, that were enjoying those extraordinary prices, seasonal conditions like they'd never seen them, cattle prices, sheep prices like they'd never seen them, they said, geez, why would I sell now? It's the best I've had of it for years and years. They're now 4 or 5 or 6 years older than they were, and now is the time for them to sell. So some of those vendors we find, particularly given they've got low debt, they want a deal done now, and so we see them taking a relatively modest haircut on where the peak might have been in 2023. They say they'll accept a 21 or a 22 price. So there's a little bit of that. We're not seeing the pressured sales like we would have in the GFC. So we're not seeing banks move on groups or whatever else in any great number. And I think the recovery in livestock prices recently will mean we're probably unlikely to see that. I think most people are working through, where interest rates are and working out how to pay. Those that sort of got caught in that web, they may be forced purchases. I think there's plenty of buyers to take those people out. So there's a level of value in terms of a correction where all of a sudden everybody says, geez, that's cheap compared to where it was last year, and they take it out. So I don't see seismic shifts downwards in value. There's a few groups out there that are saying that there's going to be a lot of properties on the market this spring. I think one of the things to be mindful of is a high quality property will always attract good money. I think it's the B and C grade properties where you're likely to see larger corrections, and that's historically where it's always been.